CPI. Do we look at this chart and think that we should gravitate kind of back towards a more historical, traditional relationship? You're looking at the CPI year-over-year change on the x-axis. Y-axis is the 10-year Treasury yield, and that chunk of trading way down there that doesn't fit with the rest is us right now.
Right, and I think maybe this is the obvious fact pattern that we all need to pay attention to, which is something is very disconnected from where it had been over the last 40 years, right? So going back to the early 1980s, there was a pretty strong relationship between these two things, right? Being the core CPI year over year, and then where Treasury yields were. What we see is that right now there's that massive disconnect down at the bottom where CPI is really high, Treasury yields are not. And I think this is part of where the bond market had taken control this year to say, all right, Fed, you're not going to move as quickly as we want. Inflation is too high. We need to find that equilibrium level where yields, inflation are going to meet, and everyone will be happier, you could say. So right now, if we just try to extrapolate where Treasury yields should have been based on past history, that number is quite a few basis points higher, right? We're talking about hundreds and hundreds of basis points, not just 50 or 100 like the Federal Reserve is talking about. So I think what ultimately has to happen is that we're going to move up and to the left. To the degree the Fed has any control over inflation, right, we've already talked, and I know you've talked with other guests about inflation may have peaked earlier this year. It's not going back to 1 or 2% like it had been in the 20-teens environment, but it'll just gradually drift its way down as yields go up. And so I think we need to find out where that equilibrium is. Great stuff, Chris. Love that chart. Some really important historical perspective for us. Looking forward to more macro discussion going forward. Thanks for jumping on with us this morning. Yeah, thanks very much, Oliver. Nice talking with you. Absolutely. Chris Maxey is the Chief Market Strategist at Wellspire. Stocks just opened a little bit lower here. Not a huge decline, but a fade from early overnight strength. We got to talk some companies and some stock movers in that hostile takeover bid in the airline space with Alex Coffey here with me this morning. Here's the NASDAQ down at 80 bips right now. Russell 2000 lowered by about a third. Bitcoin lowered by a couple $100 to about 1%. The dollar is still negative, and bonds are bid, so the yield is down. Bad Empire State number this morning, maybe helping the bond rally a bit. I'm here with Next Gen Investing co-host, Mr. Alex Coffey. What's up, Alex?
What's going on, Oliver? A little weakness this morning after an early bid last night in the futures was unable to hold. I don't think we should expect anything less than choppy markets. I was just reading something that futures liquidity is about as thin as it has ever been, 0 percentile. So wow. To me, that doesn't necessarily mean that we're going to move one way or another, but rather that we're going to move quickly wherever we go.
Our VIX hanging out at 29. That 30 area is still pretty sticky, though it did dive on Friday. The close definitely brought some renewed optimism for the bull crowd looking for a bounce. So I do think that, follow through needs to happen fast, basically, or else this is a market that might lose faith quite quickly. Bonds are pretty well bid, but generally that seems to happen now when stocks are down. Maybe the bond market's kind of approached its limit here for the moment for how much stock carnage it will accept. But that Empire number was pretty bad too.
Yeah, I would say on a relative basis, if you were to look at it, it certainly seems like the bonds are more oversold than the stock market is, given that it's historically oversold. And the equity market, while it's one of the worst starts to a year, we've certainly seen more vicious moves. I mean, just as recently as obviously 2020, we saw a much more vicious move, much quicker. So we've seen bigger, faster moves in the equity markets where the bond market is almost unprecedented. So you look at that, of course, there's a lot that's factoring into both of those. You talked about volatility. Volatility, the curve is completely flat still. The June futures are basically 29. The spot VIX itself is about 29.5. So if anything, it's a little bit higher on the short term, but it's pretty flat. Usually that indicates that right now we're getting to pretty oversold conditions. We talked a lot about the 90% down days. Friday actually registered a 90% up volume day. Okay. I don't have the stats ready, but I know just from our conversations in prior years with Mike McCurr that those are actually even more bullish historically than the 90% down days in terms of looking for capitulation and volume and buying pressure. But when you're looking at a market that very much looks like a bear market, a lot of that stuff gets thrown out of the window. So
Sure.
you're looking at here, I think that you still have to operate within that framework, that if anything, this is a bear market rally. Utilize that as an opportunity to pare down risk. I'm not saying, go into cash, but, sell calls against shares if you're worried about things, maybe collar positions, use that call premium to buy puts against shares. Volatility is still very, very high, so you're paying a lot for that protection. Any way that you can kind of, utilize maybe that call premium to offset some of that cost, possibly for the better. But I mean, S&Ps are below 4,000. We're going back and forth around this level like it's nothing. So
Yeah.
It's certainly, I wouldn't say we're out of the woods. I'll put it that way.
Guilty until proven innocent, this market right now. Trends still intact after last week. By the way, to your point, I like the framing of bonds being more oversold than stocks. If you look at the 14-day RSI, the momentum indicator, there is truth there in that, as 30-year bonds were oversold as recently as last week, registering a RSI below 30, the oversold level, whereas stocks haven't seen that now. Really, actually, they've been bordering on it, but the S&Ps actually haven't hit an RSI under 30, or the NASDAQ since earlier this year. So to your point there, just one measurement of how much bonds are selling. Okay, let's talk some airlines here. JetBlue and Spirit. JetBlue really wants Spirit. Spirit up 8.5% as a result. So I guess it's going to happen. There's going to be a merger one way or another, whether or not Spirit or with Frontier or Spirit with JetBlue. But it seems like the government might have more of an issue, I guess, with Spirit JetBlue. So JetBlue's really got to sell them on it. What's going on here?
Yeah, I've been trying to follow this one, but I haven't been as closely as maybe others. I don't know the interworkings of kind of maybe the company-to-company issues as to why they prefer one or the other. Certainly Frontier and Spirit are closer in terms of what they actually, how they operate and kind of where they fall in terms of, I guess, the quality of airline. It's definitely more of the budget side of things. JetBlue is perceived as maybe a little bit higher quality. But JetBlue, yeah, as you meant, they really want these Spirit assets. And, of course, initially, Spirit has basically said no to JetBlue, and they prefer the Frontier deal internally, or at least that's the kind of the board of directors' opinion, or that has been in recent weeks. Although the JetBlue deal was more, and it potentially is now setting up for a hostile situation. So JetBlue announced through a proxy statement a vote no, basically, statement urging shareholders to vote against the Spirit Frontier transaction ahead of this upcoming meeting. They've also announced a fully financed tender offer to acquire all of the outstanding shares at $30 a share, which is interesting because they initially were looking for that $33 a share for the actually negotiated deal. Now they're trying the hostile deal at under 30. So this is the kind of the unique kind of game theory of things when it comes to these mergers. It's actually kind of mirroring what we're maybe going to see with Twitter in Elon Musk. And of course, you got to move that into the conversation whenever we're talking mergers right now and acquisitions because of how big of a deal that one is within the tech space. But when valuations get pushed down, when things are working against these high prices, there's room for negotiation down. And so JetBlue doing whatever it can to kind of win over the shareholders at this point because it seems the company itself does not want to be sold to JetBlue. So go around the board of directors, and they're certainly trying to do that.
Okay. We'll see what the government says about the deal when we get more potential kind of conclusion to this, because JetBlue's American contract that they have is complicating the situation. So they're going to have to make the case that if they include another airline in here, that they are going to, that's not going to be anti-competitive, because it is a little bit tricky when JetBlue says we're going to be able to compete with the bigger airlines if we have Spirit under our wing, pun intended. But then they also already have a relationship with American. That's kind of odd. So I think that might be a complicating factor at this point.
It very well may be, Oliver, but this isn't necessarily a space where there's one or two players. I mean, there's several major players here. So I think one of the hardest things to handicap is how the government's going to respond to things. I'll trust those who are more in tune with that stuff. If there's concerns about it, those are probably rightly placed if that's what the experts are saying. But in this particular thing, this isn't a situation where it's, it's Boeing and Airbus, and there's only two makers, so it's not a duopoly. There's several major players. Yeah, maybe it complicates things, but If you ask me, I would say I don't see why that would be an issue.
There's going to be also a sensitivity right now when we saw that airline fares were a big contributor to consumer inflation prices in the last reading. I mean, the prices are going through the roof, so it's kind of a sensitive subject at the moment. All right, let's talk a few other stories here. I thought an interesting story is McDonald's completely pulling out of the Russian market. Hey, that's a big deal. McDonald's little changed, even with it, which is pretty amazing. But it's still just symbolically, I mean, huge country that this major consumer business is going to just say we're not even taking part of. I mean, they've been there for 30 years.
Yeah, I think this is a headline that reads like it would be more impactful than the actual impact, given that they paused their operations going all the way back, I believe it was to March 8th.
Yes, they'd already paused them.
I don't want to, jump to conclusions, but this was sort of heading in this direction. In terms of, how do you pause the operations and then kind of go back? This was sort of seemingly, they were pulling out as it was. It starts with the pause, and then this is naturally the progression. But they also note that they're going to sell those assets, or at least attempt to local businesses. So they're going to have some sort of return, I guess, is the idea. But they do expect a $1.2 to $1.4 billion charge basically to work against the company. But you put the dollar figure to it, it becomes more certain, kind of leaving it linger in this, temporary, but, not necessarily any end in sight pause of operations. I think leaves it more in limbo, where ultimately this just kind of, they wipe their hands clean of it and they move on. They write it off for what it is, and they focus on their growth in other markets and do what they can here domestically. So stock's down a little bit, but not really much more than the overall market itself.
Okay. So almost 900 stores and a decent amount of revenue, too, according to the Wall Street Journal, where Russia and Ukraine accounted for 9% of McDonald's revenue last year. And the overall sales, though, a lower percent, because McDonald's owns the restaurants, many of the restaurants in those regions, so they collect more of the overall revenue. But they're going to basically say as much of $1.5 billion up to $1.4 billion charge, and less than 3% of operating income came from both these regions. So they put Russia and Ukraine together in their sales calculus for the business, assuming they would reopen the Ukrainian stores eventually. We'll see what that nets out to for just the Russian stores. But a pretty big deal, but one that's not really moving the stock too much, just more kind of an interesting corporate story. Let's talk a few other analyst notes out this morning that might actually be moving some companies. Netflix has got an interesting note out and upgraded from Wedbush. Michael Pachter is the analyst behind it. He's going to be joining us tomorrow morning to talk about it. But this is kind of the first upgrade in optimism we've seen in the stock for a while, as he had it at neutral. Now he's saying to buy it after the carnage that's happened. $500 off the high.
Yeah, and so agree or disagree with his logic. We'll go through with some of the points, but you got to, I guess, respect at least an upgrade as the stock gets weaker, as opposed to chasing it down with downgrades, which we often see. So a little bit of a contrarian take in a name like Netflix, sort of buying the dip mentality here from Michael Pachter, upgrading to outperform from neutral, price targets 280. So still looking for a pretty big upside move. It actually is moving the stock higher. Stock's been outperforming the overall market in the pre-market session into this opening bell in the first 10, 15 minutes here. Really since this news broke, stock currently up 3.45%, 3.5%, let's say. About $1 off the intraday high, but up about $7 here. And this is after a pretty nice two-day move to close out the week last week. Very oversold stock. We'll see if it can get its legs under it. But the logic from Michael Pachter is that he thinks they're positioned to exceed their guidance for Q2. So basically saying that the over-rotation now is so negative in Netflix that it actually sets up for a possible beat, believe it or not. And this is partially due to the staggered release date of Ozark. So thinking that there could have been some optimism from Ozark, get more subscribers in the door, help their guidance, or beating that guidance that they gave forward for Q2. They said it is possible, once again, that they issued downbeat guidance for Q3, but they believe at Wedbush that the staggered release date for Stranger Things will help reduce the churn and once again set up Netflix as in a position to grow. So kind of utilizing their primary, brands, I guess you could say, their primary content parts within Netflix to keep you subscribed, as opposed to, you join for Ozark, you cancel to the next season of whatever show. If they kind of stagger it so that Stranger Things comes out within a reasonable amount of time, maybe you're more likely to keep that subscription rolling, which will help against those cancellations, which of course will set up against the company going forward. He says that they don't expect wholesale changes to occur rapidly and expects Netflix to only gradually raise prices and roll out its ad-supported option. So not expecting this to all happen, tomorrow, next month, but slowly, methodically. Much of what Netflix has done throughout its history is there's been, price increases. There has been changes to the platform, but they haven't been that abrupt. They've happened sort of slowly over the multi-decades as they become, if not the major player or the number one player in content, certainly going neck and neck with Walt Disney.
Okay, so the ads are now officially part of the bull thesis, which I do think is interesting, that it now looks inevitable, or at least it's going to be a necessary part of their comeback story. And the staggered releases, okay. So there's a few things here that I think are, more, it's not superficial. I get the strategy behind like the staggered releases and stuff, but, and the cracking down on the extra accounts, but really the advertising is going to be the major difference here, I think.
Yeah, no doubt. And Oliver, I love that you say extra accounts, because you're talking, I think, about account sharing in the sense of this.
Yeah.
Let's compare and contrast this with the digital ad space, which is kind of the number one kind of perceived way to spend ad dollars right now with things like social media companies. And you have sort of this controversy surrounding Twitter. I don't want to get too deep into the weeds, but there's understandably, there's certainly bot accounts, right? There's fake accounts, let's say, within the ad space. And I don't think that anyone thinks that that's solely at Twitter. It could be systemic across social media. So if Netflix is trying to find ways to get more accounts, where places like Facebook and Twitter maybe are overestimating the number of accounts that they have, think about where you're spending your ad dollars. There could be reason to think that there's actually value added from a company like Netflix.
It's a good case for them to make to advertisers if it turns out we keep delving into the social media stuff. There's a bunch of bots. Hey, real quick before we go, one other note that we need to talk about here is from JP Morgan. Pretty bullish on the China stocks, a double upgrade. I think of all the tech charts out there, the China tech charts are the most hopeful right now because they haven't made a new bottom since March. What's this JP Morgan report say?
Yeah, so from Alex Yao, we got a double upgrade in Baba, a regular upgrade in Baidu, and a double upgrade in NTEZ, which I believe is NetEase.
NetEase,
Yep, and so the same reasoning being applied to all three of them. It is that there's still significant uncertainties in the China internet sector, but basically that there hasn't been a lot of regulatory announcement lately. They expect early cycle sectors such as digital entertainment, local service, and e-commerce to be the first batch of outperformers. Late cycle verticals such as travel and ads should lag the early cycle ones by up to 2 quarters. So they have a lot more balanced view of these stocks because of how beaten up they've been, and they think that once there is clarity or at least lack of uncertainty, that the ones that will pop first will be your Alibabas, your Baidus, your NetEase. There also was from Andrew Chang over at JP Morgan an upgrade to neutral from underweight on JD.com and a price target raised to 58 from 40. Probably related, but no reasons were cited.
Okay, all right. Interesting note out. Okay, so some optimism. Pretty decent double upgrade for some of them there that you don't really see very often. And they have been bearish, so they have been in the right spot. All right, thanks, Alex. Nice work. Getting us started here on this Monday with some stock moves. When we return, let's discuss some of the earnings from last week in the video game space. We heard from Roblox and Electronic Arts. We'll check in on those companies and trade them when we get back.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network. I'm Jenny Horn. Here's a few of this morning's movers to kick off the trading week. Deutsche Bank named Target as a top pick, saying that investors should buy the dip heading into earnings this week. The analyst said with the pullback in BJ Wholesale and Target, it's overdone, and they are constructive ahead of the first quarter reports. Target remains the firm's top pick. Bernstein reiterated Boeing as overweight, saying the stock's recent drop was more sentiment not supported by fundamentals. Boeing shares fell 14.5% last week, even after the brief rise on Friday. The firm thought Boeing's stock had bottomed long before last week, but then were proven wrong. They said you want to buy Boeing in times of trouble, and this is not the first time investors have questioned how anyone could buy shares of Boeing. And Piper Sandler upgraded SoFi Technologies to overweight from neutral, noting that the sell-off in the shares is overdone. The analysts acknowledged there will be some headwinds due to rising rates, but the market is over-discounting the online personal finance company, which they said is poised to show significant ramp in EBITDA in the back half of this year. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Oliver Reddick.
Let's talk some video games. After last week's earnings in Electronic Arts and Roblox put a floor in the stocks. They've been firm since. Joining us, John Freeman from CFRA says the two remain strong buys. John, good morning. Good to have you here on a Monday to kick off the week with some bullishness. Both EA and Roblox seem to be putting in a floor, or at least attempting to. Let's start with Electronic Arts. Even though they lost the FIFA label, seems like market's okay with it.
Yeah, I think that their sports franchises are rock solid, right? So this is kind of the most stable in terms of revenue in the video game space amongst the majors because of the recurring revenue that is associated with NFL Madden and some of the other franchises. It also has a really solid balance sheet, and I just think it's going to be able to take advantage of all the immersive technologies and VR and AR. I think those those versions, AR and VR versions of a lot of EA's game franchises, I think that drives decent growth for the company and, might be a great way for those who are more risk averse to play the video game space.
They've still got a year downtrend to contend with on the chart, even though it maybe has been less steep and dramatic than other stocks out there, still downtrending nonetheless. Do they have a juggernaut that can compete in the first-person shooter in the multiplayer world that Activision's been dominating?
Yeah, whether they do or whether they the degree with which they can compete in the first-person shooter space directly with Activision, I think is a nice to have. I think one of the things that they did recently was to expand into mobile, which they really hadn't had any exposure to at all. They made some good acquisitions. It was actually a material part of their growth for this past quarter. So I think that's kind of more the way. Plus, obviously, the solidity of their sports franchise. I think that's what I look to when I look for when I'm projecting their financials for EA.
So the mobile side is going to be where they try and stake their ground?
I think so. Yeah, I think, and you know, to the degree that they can take any share in mobile is upside for them because they just haven't had any. You know, they've been focused mostly on console and to a lesser degree, and also PC games, really for the last, you know, for as long as anybody can remember, right?
So what about on the other side for Roblox? This one I think is a little bit trickier than kind of the staple of companies from EA. Roblox is a little bit more unfamiliar. It's new. It's been a hugely popular game. But I wonder with the post-COVID return to a regular world, regular work to some degree in school too, how does that affect their user base going forward?
So, you know, the financials were not great. I mean, the numbers were not great, but the interesting thing about Roblox is because their revenue model is very different. All of the players on there buy Roblox. So you buy dollars to spend in their world to play games and buy, you know, virtual items inside the games and these kinds of things, right? So that model makes it, you know, the video game space is hit driven as it is. So that kind of it puts a greater sort of whip on the tail of their ups and downs. So, you know, it's definitely not for the risk averse. Yet at the same time, Roblox is in a great position. I mean, talk about, they are really the one, if you believe that the metaverse is anything, and there's so much, you know, research now that shows what the metaverse, I mean, just in terms of the potential, right? I mean, these are the leading, like Roblox is the leading contender to be the metaverse a winner, or at least a major metaverse winner. And what I like about them, and when I go back to the fundamentals, is they have three solid competitive overlapping reinforcing competitive advantages. One is the network effects of a social network, which it definitely is a social network, but it's also a game development platform, right? That so that there's a tremendous amount of leverage and a lot of work that third parties do to add value to the platform, and as well as just in the particularly ex-US, there's a lot of interest in in coding, and even in US. Globally, right? Kids want to learn how to code, right? So this is actually a great training place to do that. So and nobody else really does that particularly well. I think that's really underestimated and undervalued for this company.
True. Okay. We're going to get bulled up. We're going to take that energy and trade it higher. Thanks, John. Appreciate it.
That helped.
John Freeman joining us from CFR.
Take care.
$56 price target for Roblox, $184 for Electronic Arts. It's Monday, and the stocks are up since their earnings. Let's bring in Tom White. Let's follow the balance here. Okay, Tom, if you're looking to try and trade these in the bullish direction that John's given us here, Electronic Arts seems to have some pretty good momentum to it, as does Roblox too. Roblox is up 4% this morning, so maybe these two are trying to break away from the growth downtrend after all.
Yeah, and if you looked at, maybe the stock price over the last several months, especially in Roblox, maybe you equate that to it. But if you look at MPD data, they've seen 6 consecutive months of declines as far as gaming goes in that space. So you've got, basically EA is up about 5% this year, so it's outperformed the overall market. But it just hit. Basically 2-year lows last week before those earnings came out. So on a nice little run here. So looking at EA, if you want to get bullish up on it, it just pays a small dividend, about a 0.6% dividend yield. So how do you play this as opposed to buying the shares outright? Maybe you give yourself some duration in here using the option market. So I looked at going out to the September cycle. So giving yourself about 120 days till expiration on this one, where I'm going to buy a call vertical as opposed to buying the shares. And I can offset some of my costs on that bullish position by selling an upside call against the ones that I'm buying at the money. So buying the 125, 145 call vertical in EA, if you pay roughly about a $7.20 debit on it, that's going to be your risk as opposed to buying the shares. So it's less capital intensive and you're leveraging the option market. If you pay $7.20, that's going to be your risk, $720 per spread. Your break even $132.20 to the upside over the next 123 days on this one. So you don't need that big of a move to get above that break even, and you're giving yourself plenty of duration in this example.
Okay. All right, so upside strike calls, 125, 144 strike call spread, and thinking about 126 bucks right now. All right, so you're looking for a decent continuation from here, but one that's not unreasonable. We get through 130 bucks, and EA suddenly is the highest it's been since February, and maybe trying to turn around. Roblox has got a longer way to go, though. Roblox has a lot more proving to do, given how much it's been beaten up.
Yeah, down 65% so far this year, and we're seeing a nice little pop today. So you maybe want to use the option market here too. He's got a $56 price target. That's you got to remember that's a 12-month target. So if you want to do something a little bit more conservative, and your duration's not as long, but you want to take advantage of maybe a pop back in here in the shares, you can use the option market for that. So I looked at a customized type of option strategy where I'm still risk defined down to the downside in case it does slip again. We've seen that volatility and turmoil in the overall market, and Roblox is right in the middle of it. So looked at going out to the July cycle here, so giving yourself a little bit of time, a couple months until expiration, where I'm going to use a put vertical, which is bullish. I'm going to sell a put vertical, sell the 130 or sell the 30.25 put vertical, so $5 wide, to offset some of the costs on a bullish call. So you're using a neutral to bullish put vertical to help finance that at the money call that you're going to buy in the option market. So buying the July 35 strike call, offset by selling that 30.25 put vertical. If you pay roughly about a $2 debit for that, it might be a little bit more. Your break even is about 37 to the upside over the next 60 days in this particular trade. So you're giving yourself a couple months until duration, but you're still risk defined on the downside, where you get to take advantage of any upside that you're going to see in the shares. So I think that's really key in this type of market. And implied volatility still elevated in all these names due to the pullback that we've seen, not only in these stocks but in the overall market. But this might be the way to play it, where you're offsetting some of your costs on that bullish call.
Okay. Interesting. So a little bit more, upside potential here, unlimited if the thing does ramp. If you're going to trade Roblox or a stock like Roblox higher at this point, you might as well swing for the fences, given the high beta nature of it. If it rallies, it's going to rally huge. It's not going to creep its way along all slow and steady. Roblox up 4% this morning in a down market. Pretty encouraging for the stock. Thanks, Tom. Good stuff. Trading it with the bullish case from John Freeman at CFRA. Coming up, hour 2. More games. Take-Two earnings are around the corner. The owner of Grand Theft Auto's franchise will be the next video game stock to report. The shares are trying to follow along EA and Roblox this morning, but they've been blasted here over the last month and a half. So Take-Two will have some proving to do. We'll talk about those numbers and the way to win in an inflation market. Got a guest joining us with a fund that's up on the year. Lo and behold, up. We'll talk about what's in it, how it's doing so well.